All right. Hello, everybody. Well, I just want to thank everybody for attending today's fireside chat. I'm happy to be here with Steve Allan, who's the CEO of the parent company. I kind of wish there really was a fire to spark up here because it's been a little cold with the blizzard and everything, but we have to make do with what we got. So as many of you know, the parent company comes from the recent de-SPACing, that's the term we use now, of the Subversive Capital Acquisition Corp, which to date is the largest cannabis SPAC. It brings together a couple of entities, Caliva, Left Coast Ventures, Roc Nation, which we'll talk about as part of our discussion. And they were consolidated to dominate California, the world's largest cannabis market, through a transaction that's valued up to $1.2 billion. The parent company is by far the largest, or right now, in California by revenue, integrated vertical footprint, brand portfolio, and its balance sheet. So we got the big fish in the big pond right now. So for those who don't know me, I'm Matt Karnes. I'm the founder of GreenWave Advisors, which I founded 7 years ago in 2014, which is like a really long time ago in this industry. I served prior to founding GreenWave. I started my career, I served as an auditor with the Big Four, then went on to work in various financial roles at Mexico. I went to work at Chase Bank, where I wrote the accounting policies on corporate derivatives, or how to account for derivatives, which is the most boring job I've ever had in my life. So I'm was happy to leave. Upon completing my MBA, I started my career on Wall Street as an equity analyst. I served on the sell side for a few firms, Wells Fargo, Cowen was the SG account at the time, Bear Stearns. After leaving Bear Stearns, I worked as an analyst at a hedge fund, a long short equity fund in New York. And then after that, GreenWave was born. So the next stop, all the combination of the skills enables me to connect the dots, read between the lines, and ask the probing questions, which, Steve, I will not do. I will not ask you any probing questions today. And then
I hope that's not the case.
With that?
I hope that's not the case.
Right. We provide due diligence for family offices, hedge funds, private equity firms, and we do valuation work and all kinds of good stuff. We just don't do windows. I'd like to give a shout out to Noah Kana and her team for assisting with the logistics for this webinar. As many of you know, maybe some don't know, Kana Global specializes in curating virtual and live events for institutional investors, family offices, and ultra high net worth investors. Its Cannabis Private Investment Summit, which many of you have probably attended, is the longest running investor education conference in cannabis. If anybody would like the slides to today's presentation, please reach out to me, mkarnes@greenwaveadvisors.com. And to sign up for our GreenWave Buzz briefings, you can visit our website at www.greenwaveadvisors.com. The plan is to have a briefing on the parent company within the coming days, so you can reach out for a copy. And with that, let's get the chat started here. You all comfortable, Steve?
Absolutely, let's get going.
Okay, all right, here we go. So I thought I'd start out just kind of giving a backdrop to the industry, where we are, where we were, etc. So we're 7 years in since the first U.S. Recreational use market was implemented. That was the Colorado experiment, and it has proven successful. We're 7 years in. No, the sky hasn't fallen. U.S. industry is at an inflection point with the growth prospects and legitimacy beginning to materialize. So early on, as many of you who have been with us early on, there have been a lot of casualties along the way, but we're now at the point where things are beginning to really materialize, and it's an awesome opportunity for investment. Last year's election was the catalyst to change at the federal level. With the green wave, more states move forward with legalization. Had to say the green wave there after the 5 states ballot initiatives passed. While timing is uncertain, we expect a less turbulent ride to the finish. Now, what I mean by that is under the Trump administration, we first started out with Jeff Sessions, who kind of had some rhetoric early on. Then we had Attorney General Barr, who tried to pretty much throw all of us under the bus. And how he did that was he implemented or initiated some antitrust reviews of some of these larger transactions, which never made sense to me. It consumed time to have DOJ antitrust issues reviews in an industry that's in its infancy. That's fairly illegal. Makes no sense. But I think it was a way for him to passively aggressively try and limit and stop the bus from going forward. So where we are right now, I think we are basically, we just all got out of a Chevy Chevette with bald tires, and we're going into a Maserati for a smooth ride to the finish. I kind of look at it now. So although we don't know the timing, we don't know when federal legalization is going to happen, we do know this: we're not going to have the problems that we had in the past. It's not the headaches, not the consumption of capital, unnecessary reviews and so forth. So anyway, so if we look at the U.S. cannabis industry as a whole, we are looking at this year probably roughly hitting about $20 billion. California is the most important market in the United States, probably arguably one of the most important markets in the world for that matter, the largest, so sure. So if we look at the revenue growth and we look at California, we look at California as a percentage of the total US, we're getting a CAGR of about 30% over the next 2 years in the US. Most of that's going to be driven by new markets that are going to come online, new states are implementing legalization, etc. And then we look at where California is roughly 10%, but I do think that's much higher. And I think, there's a lot of shifting going on in the last year with COVID. I think a lot of consumers are making the shift to medical that were normally rec because it's cheaper. There's no sales tax in California. And so some of the data that comes in is recreational. That's not necessarily capturing the medical market. So all in, I think it's probably much higher. But if we look at our company here, the parent company, their 2-year growth rate is exceeding the industry as well as California, where they are the big hit. So it's, they're, based on the projections, about 79%. So really the market is, the growth of the market, a big part of it, as you probably all know, is going to come from the illicit market, right? The illicit market, I personally, it's really hard to determine what the illicit market is. I'm not a big fan of asking people who they smoke, what they smoke, where they smoke, all that kind of stuff, because there's really no way to figure it all out to know if you're right, if they're telling the truth, or whatever the case may be. So what I do is I try to get a handle. The only data point that I could point to is confiscations by the authorities. So how much pot was eradicated by the DEA, how much was confiscated at the border. That is a component of the illicit market. Now you could put a multiplier on that, et cetera. The only thing I can tell you is that directionally, it seems, looking at the data that's come in, that the illicit market, the confiscations, law enforcement has decreased. Now that could very well be because, hey, look, they don't really care. It's, it's not a priority, et cetera. But at the same time, on the flip side of that, it is in their best interest because it's taking away from their revenues. So if you look at 2017, which I find the most interesting, is there was a big drop, 35%. That's right after the rec market was implemented in California. So that, could indicate that there was a shift. There was another downward movement in 2018, less seizures and so forth. There's an uptick in 2019. I'm not really sure what the reason for that is. Go back here. And then if you look at the number of sites that were shut down, the eradicated sites, there was in 2019, 1,300. That approximated how many licenses there were. That's how profound the illicit market is. and the data is here for the indoor. And so we see a convergence of this is by GreenWave, some GreenWave trivia for you all. This is our logo, the black market going down and the illicit market going up. So as we talked about in the introduction, this is a result of the SPAC, this Subversive Capital Acquisition Corp, largest SPAC. They put together the parent company, and you can see on the chart here, $575 million, which is quite substantial. It is clearly the largest. If you go down the list, you add it up, 2.8 billion in SPACs, in the last year or so. And then, I kind of have a breakout of the target and completed and so forth. There's 2 SPACs that were to go into where it was believed that they would acquire a cannabis-related company, but they chose to go a different route. If you look here, you can see just, the world in general, there's about 376 SPACs right now that are active and so forth. The key point here, the takeaway is that the cannabis industry accounts for 1.5% of the $95 billion of companies that are SPACs that are seeking to target. And then you can see here on the right how profound 2020 was in the SPAC world. Probably the only thing that was good in 2020, or there was a silver lining, is that the fact that the SPAC market ticked up so much. And already in 2021, we're at 30 billion, and that's only in a month. So a lot of excitement around SPACs, and cannabis is certainly a part of that phenomenon. So Steve, I thought I'd hand it off to you to kind of give just a brief overview of the transaction and the pro forma capitalization.
Yeah, no, I appreciate Matt. Great overview of kind of what's been going on and a lot of the excitement around cannabis. Obviously, even the past week and the past month have been phenomenal for cannabis stocks, and really great opportunity to demonstrate that as you said, the into prohibition is coming in this administration, and we all recognize it, and it provides an incredible opportunity. Specifically for the parent company transaction, we really feel like this, beyond being the largest cannabis transaction to have taken place, it also really is a one that demonstrates a real focus on that long-term growth. And as you said, we don't know when something's going to change federally. We know it will change federally. And that's really a lot of what this alignment was, and really a foundation in bringing together the parent company. So bringing together Subversive Capital Acquisition Corp and the targets, right, with LCV and CSU and Caliva and Monogram to be able to form the parent company. Overall, this transaction was designed for long-term alignment. That was really, from the very beginning, it was one of the things that brought the operators ourselves together with the sponsors. That was really that idea of building, a 100-year company, the next great brand name. It just happens to be in cannabis, and really taking that aligned focus. So you do look through the consideration. It was predominantly share-based, and really, to be candid, it was 100% share-based. The math that's here says 92%, because I guess legally that's what it was, but really the $40 million was actually all obligatory, right? So there was debt at Caliva and LCV of 10 and 15 million, so you get to 25 of the 40. And as part of what was a transaction going on between LCV and CSU, where LCV was acquiring CSU before LCV got acquired by the parent company, that transaction had an accelerator clause in it that if that took place, CSU needed to be paid their last payment of this $15 million, which was part of LCV's acquisition price of CSU. So net, when you look at it, yes, it's technically 8% cash that went out the door, but really it's 100% of eligible because we did really find it important to, when you're sitting on a balance sheet as large as ours, there's no reason to have debt. And so that's how we really went to clean that up. Beyond just the upfront, it's also alignment on an earn-out structure. And this was something that was important to us, and we feel like will be important as we continue forward with our mergers and acquisitions and inorganic growth. It's always about alignment. And so when you look at how this was structured, everybody is taking a portion of their stake in an earnout, and that earnout is aligned with investors because it is tied to stock price at $13, $17, and $21 based upon a 20-day volume weighted average price. And so again, what it really is saying is we believe that the equity value has tremendous upside opportunity, and we're all willing to put our money where our mouth is in stating that. So the sponsors took and put shares, a substantial amount, over a third of their shares tied to these milestones, as well as when you look at the targets, whether that was Caliva, LCV, even Jay-Z with Monogram, also took a portion in these milestone earnouts. So again, really making sure that there is the long-term alignment and focus on driving long-term sustainable enterprise value. And that's really, I think a unique function, and really something that really, I think is imperative that we have that type of alignment along the way. So that really gives a highlight of the overall viewpoint of the structure itself. Along with it, there was a $63 million private placement that was done at the same price as the offering at $10 a share. It really showed a lot of pent-up demand. There was a target to raise just enough to cover the closing costs, which was about $40 million. And we had such excessive demand that we had to open it up. And this actually was a capping of it at that 63, basically to draw a line between the insiders and the Roc Nation participants who all were clamoring for it. And so at some point we did have to draw a line and cut it back, but it's indicative, I think, of some of the excitement around it. On top of that, just another piece of information that folks sometimes don't fully understand within these SPAC transactions. I know, because while there are a lot of them that you showed on your list, the reality is there's not a lot that have actually consummated deals. And so it is a scenario where people are still learning how this operates. But it's one of the things that we also consider as another incredible advantage for the parent company. While we're walking out of this transaction with just under $300 million worth of cash, that's net of redemptions, net of paying off debt, net of all transaction-related expenses. There is an opportunity for us to pull down an additional $411 million total of additional equity through the warrants that exist out there. They're set at an $11.50 strike price, but we do have the ability to call those warrants at $18. So it does give us the opportunity to be able to do that. So as we think about, the optionality and the flexibility, it is incredible to know that we have that opportunity within the structure that we've set up to be able to do this. So net out of it, we feel like we've very carefully structured this deal, structured in a way to be focused long term, structured in a way that really is aligned with the investors, and it places us at a situation where we are the largest balance sheet in California cannabis, period, and one of the largest balance sheets in all of U.S. cannabis. And we think that really provides us an incredible opportunity to execute the roll-up and consolidation of California that is going to happen here over the next 12, 18, 24 months.
Sure. And with the run-up today, you're pretty close to some of those payouts and the warrants.
Yeah. I mean, it is interesting. I mean, I had someone ask me the question the other day. They said, your stock's up 4% right now. Like, what do you attribute it to? And let's be clear, there's volatility galore right now. These things are moving, 10 and 15 and 20% on a daily basis when you're looking at it. Again, I'm not focused on the short term. I actually ironically don't look at the stock price on a daily basis. So if you're telling me that it's up today, getting close to those, great. That's good to know. But really for us, it's about long-term execution. It's demonstrating that value as we go forward. So, great for our shareholders, and absolutely want to do as best we can by them and help them to achieve tremendous returns. But we also look at this as not an opportunity for someone to gain, 10, 12, 15, 20%. But we're really looking at this for our long-term investors to be, achieving those venture capital-esque returns and some of the returns that people have gotten off of the MSOs like a TrueLeaf, where they've got that 10x return on it, and we're going to be that next 10x opportunity.
Sure, and even despite the run, I would venture to guess that you're still trading below your peer group. This is actually outdated now. The peers, your comps to like a 6.3 times this year and 4.5 next year. I don't know where this is all shaking out, but I would venture to guess that you're still at a significant discount to that group. All right, well, I'm sparking up the make-believe fire here for our little chat. As you were talking about California, largest market, great opportunity, it was off to a really, really bad start. I don't know how far along, we are right now in California in terms of it really sort of being, the best place to be. There's still, well, it is longer term and, mid to longer term, but there's still, maybe some operational issues that have to be worked out by the regulators. But it's, really, there are a very few success stories. There were, high flyers, MedMen, and Ease. Now, I do know, and this one thing I don't think people realize is that, this industry obviously is new. It has been illegal for many years. So early on, the people that were working in this industry came to the industry with not the experience that folks have in other industries. Having been an auditor, doing tours of facilities, seeing how, cash is sort of, kept lying around in some instances, having to deal with all that, the reconciliations and this, that, and the other thing is a lot of extra work that's involved. So part of the problem maybe is that, people went public too early, they weren't ready, didn't have the credibility. But in your sense, what do you think was a problem short of those issues?
Yeah, no, I think it's D, all of the above, right? It is the reality. When you look at the California market, I actually draw a parallel to .com, right? It's one of those things where it has tremendous potential. It got overhyped. There was a green rush that took place. I look at it and say, remember back in like 97, 98, if you had a guy, a dog, a garage, a URL, and you could go raise a couple $1 million and to go start an internet company, right? Just switch out URL with a license or an application for a license. And people were jumping all over it without the understanding of what it was. And the reality is it is one of those things where when you look at the overall market in California, the overall opportunity, it's massive. But building a large, scalable business that can take on substantial amounts of hundreds of millions of dollars of capital to produce billions of dollars of enterprise value, that's tough. It takes really people who have built businesses before, who have the ability to work throughout it and understand long term. It's investing a substantial amount. Take Caliva as an example. Caliva invested $200 million into infrastructure. That's not just the sexy infrastructure of come look at our indoor grow facility, which blows you away type of a thing, but it's building out ERP systems, digital systems, HR systems, like things that in I don't want to say normal businesses, in non-federally illegal businesses, you have third-party providers that you can go to. A lot of it doesn't exist within cannabis while it's federally illegal, and so that's some of the stuff that folks I think got caught up in. People were raising too little capital, believing that the spigot would be always turned on and they could go refill from there. They didn't build the right kind of teams and advisors around them to be able to do it. And so net out of it, you ended up in a scenario where you had a lot of hype and not a lot of execution. A good parallel I give is, I remember in 2002 reading through the HBR article that was breaking down, the .com bubble, and was walking through the idea of getting your dog food delivered to you, and was laughing at the idea that you had a gross margin that was less than the cost of delivery. And so how in the world are you able to, deliver dog food? Whoever thought that a negative unit economic business that you could just scale and grow it and suddenly it was going to be okay? It was going to lose money, and the more you delivered negative unit economics, the more you lost. Let's look forward. I get my dog food for my dog off Chewy.com delivered to my house. So it's not that it was a bad idea. It's that the timing wasn't there. The infrastructure wasn't there. The consumer understanding and acceptance wasn't there. And it took all of that getting built out in the internet days. I mean, it took 8-10 years to build that out to where there was viable businesses. And so you did have seen over the last 10 years incredible growth in that. That's the same thing that's happened in cannabis, but it's on a hyper truncated timeline. So instead of it being a wave that took, 6-8 years to build up, and then 6-8 years where it went back down, and then another 6-8 years, 10 years now to build back up. The reality in cannabis is everything is hyper growth, hyper fast. And so we do joke, 6 months in cannabis is 6 years someplace else. And I think we're seeing that take place. Yeah. And so what I think you have is California 1.0 was too much hype, not enough execution. And then the bridge that happened thereafter ended up actually being a handcuff. And what I mean by a handcuff is folks couldn't go raise equity dollars because they raised it too high of a valuation to begin with on the capital they raised in 17 and 18. They hit 2019, there was a downturn. Only thing they could go after was debt because it's federally illegal. That's tiny marketplaces you can go to receive that. And then there was usurious debt that was at 16, 18, 22% interest rate. Well, say bye-bye to any free cash flow, which means that model is not investable. That model is not growable in that particular case. And so I think that's where we've ended up with getting to this point of, wow, California is that quintessential, high potential, low execution marketplace, and it's really turned a lot of people off of the California market.
Yep, and coupled with the high interest burden, tack on like a 60% tax rate. That's really difficult. There's a high cost of prohibition, which we'll talk about in a minute. But another thing I think about California, one of the problems is as you recall, it started as a quasi, sort of legal medical market. So it was legal, but it wasn't regulated. So you had a total, complete free-for-all for many, many, many years. And, there was no adult supervision, right? So, what do you mean I have to file a tax return? What do you mean I have to, abide by the law? What, are you kidding me? So there was all that kind of stuff. So I think that probably added to the problem, trying to make these people grow up or try to, and then have the adults come in and, run the show. So there are a lot of problems, but it's really exciting because things are really moving forward. Things are getting cleaned up. People, the government or the local municipalities are learning, and it's a learn as you go. So in a way, it's really kind of very, it's a good time to enter and expand in California because a lot of those problems have sort of gone away. You're stepping in now with a huge opportunity. And I do think that, the illicit market is going to continue. I mean, that's where a lot of the growth is going to come from. And those slides I showed before on the illicit market, I would say like 90% of that is in California. That's, and that doesn't mean that.
Yeah, but Matt, I do want to cut you off a little bit on the illicit market because I hear a lot about the illicit market. I just want to make sure I educate people to the illicit market because it's an easy thing to put it under this high-level moniker. It's actually infinitely more complex when you get down, but I'll try to break it into just one level lower for people to understand. There is an illicit market, and I think a lot of the data you showed, right, is focused on that, which is there's 10 million plus pounds of cannabis that's grown illegally on federal lands in California. That cannabis does not stay in California.
Oh yeah, yeah.
If you go buy cannabis, in Carmel, Indiana, at a Walmart parking lot, like you're getting some Humboldt illegal cannabis that's grown on federal lands, and California doesn't police those lands because they're federal. The federal government doesn't police those lands, but that's not really what actually comes into the California market. So when you talk about the idea of there's an illicit market that's going to give way to a legal regulated market in California, I actually don't worry at all about the cultivation side of it that's taking place. But where I look at it more specifically is on the illegal dispensaries. And you hit the nail on the head, right? There was 20 plus years of medical, right? Quote unquote medical in California. Yeah, it wasn't. It was just a legal way to buy weed instead of buying it in that Walmart parking lot, right? So the reality was that there was 10,000 dispensaries in 2017, right? Today, here we are 3 years after the legal market, there's 700 dispensaries. I mean, that's a massive drop. Over 90% drop in dispensaries when you talk about from upside. Now, does that mean all the illegal ones magically disappeared? No. All right, let's be clear. If you went on Weed Maps a year ago, you could find 5,800 dispensaries on Weed Maps. So run the math for me. Yeah. Run the math for me. There were 600 retail licenses back then. So you're talking like a 10-to-1 ratio of what's there, which meant 90% of what was listed was illegal. California applied some pressure on Weed Maps, and guess what? They stepped forward. They helped clean it up. Guess how many you can find on Weed Maps today? 2,700. We're still at 700 licenses. So how are you finding 2,700 dispensaries? So when we look at the illicit market, that's the part that I think people need to really understand.
Yeah. No, I totally. And it's it's going to hopefully over time, the illicit market will go away. Not entirely.
Yeah, but it's an access problem, Matt. I mean, I want to be very simple on what this is, right? The ratio of dispensaries to adults 21 and older in California is equivalent to Florida, which is a medical only market. Like, just to let that settle in for a second, the largest recreational geography in the entire world, larger than Canada from a consumer perspective, has the same as one of the best performing medical markets out there. Like that's a problem. But the reality is, you have the conversations with regulators, you have conversations with the governor, and you say, well, why don't you do something about it? Well, they point to one and one thing only, and it's what you brought up. The way the California market was designed, it is local level controlled. So the state put in place a program, and then the local municipalities have to put in a program to then be able to have operational facilities within their geography. Well, if you look at it, 60% of California voters voted in favor of legal recreational cannabis in 2016. Just before COVID hit, so let's just take January of 2020, 70% of cities and counties in California did not have a program in place. So when you think about the access problem, that's the big issue. And honestly, I know this is going to sound awful to say, but I think that there's a silver lining to this COVID cloud, at least when we come to cannabis, right? Which is, it was deemed essential, and so it helped to wipe a little bit of the stigma off of it. And we had 50 years of war on drugs, egg and frying pan, just say no culture that you had to battle. So there was that helped to bring that about. And the second component is, these municipalities are feeling a fiscal crunch like they haven't felt in decades. And so they need jobs, they need tax revenues. You saw 31 cities and counties pass ordinances in November as part of the election cycle. There's even more that are doing it outside of the election cycle and are just doing it via mandates at their city council levels. So we're finally seeing the hesitancy that was taking place at a local level, it's disappearing. And that's really going to open up access. And when it opens access, it solves what the state needs to be able to do enforcement on the illicit market, specifically the illegal dispensaries. You need a program in place as an alternative, because if you go crack down on illegal dispensaries, which, by the way, you know where they're located, their address, their phone number, even their operating hours, because they've listed on weed maps, right? You know where to go if you're doing that from the perspective of cracking down as a regulator. And so from that enforcement perspective, though, if you do that and there is no legal market for people to turn to, then it will just pop up someplace else, but you won't have a directory of exactly where they're located and where you need to go crack down. And so really that's part of the balancing act, is it's a little chicken and egg. You need a viable set of access points for consumers to achieve and receive their cannabis to be able to then go crack down. And so really with all these new cities putting programs in place and now starting to see this tipping point where this is going to shift from having, 2/3 of these cities and counties without programs to probably over the next 2 to 3 years, 2/3 having programs in place and thus providing greater access, then you will see the crackdown on the illicit market. As you see that crackdown, then you see greater opportunities and it provides greater tax revenues. And a perfect set of examples that I can give you is two, Los Angeles and Fresno, right? Los Angeles did a tremendous job trying to build a social equity program, a huge supporter of it, really believe in what they're trying to do. Unfortunately for Los Angeles, as they did their program, they got lawsuit after lawsuit after lawsuit. And we received notification that we got a license in September of 2019. We still are waiting to receive the license, right? So unfortunately, it ran a little bit late, but right prior to that, they did a crackdown and shut down over 400 illegal dispensaries. They knew that they needed to prep for their legal market. Unfortunately, they just did not anticipate that the applicants who did not receive licenses were going to turn around and sue them, and thus put the entire program in jeopardy and on hold. Now they're working through that, but that's an example of here's the largest cannabis consuming population in the state. And they cracked down when they saw the opportunity to crack down. And that was great to see, just unfortunate that the second half of that didn't come through, which is the legal market to do it. The second example I gave was Fresno, California. We opened a delivery depot out in a town called Hanford, who's been great supporters of cannabis throughout the years. And they just put in place a retail program. We participated in it. We were only one of 2 licenses. The other one is not operational yet. It is the only legal dispensary and only legal delivery service within 30 miles of Fresno, the 6th largest population in California. And the reason I say that is, if you look on Weed Maps, there's over 50 delivery services listed delivering to Fresno. But there is nobody within 30 miles except for us. So put it a little perspective as to how much is illegal deliveries. Okay. But that delivery depot is our fastest growing depot in our history of opening up delivery depots. And it's our 6th depot that we're opening up. And when I say it's fast growing, by 2x over the next fastest delivery depot growth out there. So there's this pent up demand because Fresno is a legal cannabis desert. It doesn't have a program in place. It's putting one in place, which is great news, but it doesn't have one in place yet. And so that just shows that there are consumers out there that have no choice but to visit the illicit market because they do not have access to the legal market. And when provided that opportunity, they jump at it. And so that's why I just really want to, it was a long-winded way to really explain the illicit market, but I feel like those nuances really are what help people understand why we're so optimistic on what we call Cannabis 2.0 in California, which is now you have the combination of the politicians following the social movement, an expanding social movement that really is supporting of cannabis, and you're getting an opportunity where you've essentially seen a lot of the organizations that weren't built for long-term growth could not survive the downturn and essentially went out of business. As you combine those together, there's an unprecedented opportunity to really roll up the California market and expand in the California market. And that's why we do believe that This is actually, the second, I guess, green wave, to use your title here, within California that will take place, and the one where actual returns will be received.
Sure. To your point before about, where, a known address, working hours, and so forth, that's an issue for public safety. And as we look at and we think about banking and cash lying around, if nothing else, and then so if we look at, say, $20 billion this year, right? If you take, I don't know, take 25% addition to that for the sales tax that's collected, right? There's a lot of money floating around. In California, what was it, about 5 billion, 1.25 of that. People know where these dispensaries are, what their hours are. They have plenty of opportunity. In fact, there were, I think right when COVID hit, there were a lot of robberies, like in Colorado and so forth. But how are you guys dealing with cash? How are you managing it? I mean, clearly something has to give pretty soon with the banking laws around cannabis. Something has to change, because in my opinion, the industry is not sustainable in its current trajectory if we do not have change, because it costs too much money. There's a high cost of prohibition. And obviously, banking, the compliance and everything else around that is a cost. There's the public safety issue, et cetera, et cetera, et cetera. So, what's your secret sauce for, is it time to soon take the cash from underneath the mattress, put it in the suitcase? I mean, how should we think about it?
No, I think you bring up great points in regards to what are the barriers that exist. And look, it's a double-edged sword, right? I can sit there and complain about all the friction and difficulties because cannabis is federally illegal, right? You can't access banking, you can't access capital markets, you can't access software and ERP systems, you can't access the same kind of audits. And there's so many things that a normal business doesn't even think of, right? That credit cards, right? Like you can't access any of this stuff. Those are impediments, but those are also barriers to entry that when you solve those, right, you get a competitive advantage. And that's something that the parent company made sure to solve, right? So we have implemented, ERP systems. We know real-time inventory across our entire network, which is covering over 14 different locations at any given second of the time. We have it all tied into business intelligence, visualization software. We can see those reports. Like, that was hard to build, but we built it. Similar thing in banking, right? We really took the fact that we are, a very detail-oriented, well-documented organization, and so a lot of banks actually were interested if they're going to try and experiment and try and get ahead of what will be eventually a very large banking segment when this is federally legal, when there is protections from a safe banking perspective. And we've worked through that. So we actually are openly banked by 4 different banks, 2 of which fall into the classic California, only banks. So they aren't necessarily subject to the larger cross-border concerns. But we have 2 international banks that actually are working with us through this process, and they've done it because they recognize that this is a business they want to be in long term. And so for us, it's actually an entirely transparent process that allows us to do 2 things. One, to accept electronic payments via ACH, because we've provided full access to our backend ERP systems to these banks so they can real-time run compliance at any time. And that's an expensive, costly thing to do, but it's also the thing that allows them to get comfortable with it. And so we also, it's the irony of ironies, we on a daily basis have armored cars that are picking up cash from all over the state and are delivering it to the Federal Reserve and deposit it in the Federal Reserve into our bank account.
Yep.
Yeah, and it is costly, but we understand that is part of what you have to do, because we are not going to go bury millions of dollars in our backyard, right? It's just not going to happen. We understand that the best way for this to really shift and come to fruition is to demonstrate that businesses can do it, to bring these support services to understand, in order to pave a pathway for everybody else. And that's something that we just saw it is a cost of doing business today, but that's part of being a first mover. That's part of being on the front end of that wave. And we know it, we embrace it, we work through it, we've done it, and now it's actually a competitive advantage that helps us grow faster than others.
Sure. And everybody in this industry, I mean, when new investors come into the space, and they're like, oh my God, look how much cash they're spending, and this, that, and the other thing. Yes, some are doing it, more so than others. Some are more disciplined than others, et cetera. But as I was saying, there is a cost of prohibition. And the fact that you have to have higher, armed guards, to move your cash, that's ridiculous relative to other industries, right? So looking at your pro forma, I want to kind of shift to financials, because we don't have a lot of time, and I could sit here and talk to you all day and all night, because this is like what I do. But the losses on your pro forma financials, it seems like the losses are narrowing by a big margin, right? So if I look at 2019, I think it was like 165 million. Up to September, it was like 50 something million. But then if I annualize that, extrapolate it, you get to 75. Well, much improvement over prior year. So with this transaction, how soon do you expect the synergies to kick in? And can you quantify what synergies are going to come out of the transaction? That's one question. The other,
yeah.
Go ahead.
No.
The second part is you guys have done a really great job relative to other MSOs in managing your tax structure and your taxes. So how have you been able to do that? And will that also be something that you'll be able to carry forward into this new entity?
Yeah, I think what may be helpful here, Matt, I don't know if you want to stop sharing your screen. I can at least bring up the financial projections you're talking about, so other people can see and understand. So if you just stop sharing, at least we'll give a visual so people can see what you're asking about, and we can go from there.
Okay, so I hit the stop share button. I see, this is why Noah's helping me, because I not really.
There you go.
So, okay, there we go. Okay.
Awesome. Okay, so appreciate that. So let me share here so people can see. So yeah, from a financial perspective, as you look at it, clearly there have been losses, and a lot of that is around the need to build the business and to do all the expensive things that you've just discussed. But the good news is when you build a foundation that is built to scale, it's expensive to start with, but then you can scale quickly and you can actually build upon it. So yes, we have spent substantial amount of dollars building up all of our assets for our vertically integrated infrastructure. So whether that's in the cultivation side, the manufacturing, the distribution, or expanding direct to consumer. But that does include, like I broke out, all the compliance, all the regulatory, all the IT systems, all the security protocols. It's all expensive to put in place. Unfortunately, there's not a third party you can just go to and outsource it like you can in a lot of other industries. You have to build it. So it's expensive, right? And we've spent that money, and that's why we actually say that the parent company could not be coming together at a more perfect time, right? You have the social and political changes that are taking place, and we've invested 5 years and over $300 million between the collective entities to build out the infrastructure that puts us at this inflection point where now we can hit that accelerator with the capital that's on balance sheet from the SPAC transaction to be able to grow and scale. And as you grow and scale, that starts having higher bits of contribution margin that are flowing to the bottom line. And that's really where we're seeing this inflection point that we're at right now and starting to head towards that trajectory. So a lot of this is just about understanding that it's taking a long-term viewpoint. It's investing for that ability to be able to scale when the timing is right. That timing is now, and that's that acceleration that we're going through. And so it really is an exciting time for us when we look at it to be able to see it. So this is all just about having spent the time, effort, and money to build something that you can build upon. And that's something that's actually relatively unique in California cannabis. In regards to your question specifically on 280E and what that taxation structure is, I mean, one, I think 280E is single-handedly the largest drag, period, full stop, on legal cannabis. So I understand that there's a lot of hype that goes on about, excise taxes and cultivation taxes and local taxes. And I get that, but that's not what the drag is. That's actually part of being able to fund the regulatory environment necessary to have a very strong legal cannabis market, right? The same thing happens in alcohol. The same thing happens in tobacco. The same thing happens in gasoline. Like it's pretty natural, right, that you have that across the board, because it's how you get to the regulation to ensure the safety of the consumer. We absolutely need to ensure the safety of the consumer. So I'm not opposed to taxes. I am massively opposed to 280E taxes because it's something that's arcane. It's from what, 30, 40, 50 years ago now, right? I guess probably 40 years ago now. That is not applicable. There's no reason cannabis should be there, especially when you look at the UN descheduling cannabis at the recommendation of the World Health Organization. Yet we haven't done that here in the US. That really is the thing. If I had to ask politicians, first and foremost, the thing you need to do is you need to eliminate the 280E tax, because it is just creating a drag, and it's causing for engineering of architectures of how businesses run, so that you're minimizing taxes, just like any business does. I mean, I'm sure everyone probably knows, how little taxes Warren Buffett pays and how little taxes Apple pay, right? So everyone engineers for tax optimization, and the same thing happens in cannabis. For ourselves, well, we have had the benefit of not having to pay substantial 280E taxes because we have been investing in that scalable infrastructure, and we have not been investing necessarily in how are we maximizing our direct-to-consumer revenues, even though we're not optimized from an OpEx perspective. No, we've built this model to be efficient. We've maximized what those margins look like, and then we've essentially been using the net operating losses to offset that 280E. That being said, going into 2021, we will have a 280E tax bill that we have to pay. And unfortunately, it is literally the difference between our EBITDA being positive and our free cash flow being negative. And that is just the reality that we're dealing with. When you look at it, you can see a gross profit forecast here of almost $150 million, right? By definition, that means that we're going to be paying, somewhere around $30 to $35 million in federal taxes, and there will be state taxes, which is going to take that $34 million in adjusted EBITDA, and it's going to bring it down to slightly negative. And that's just a reality of where we're at. And part of what we're doing here is we're also, I never want to bet on a politician, and I'll never make the mistake of betting my business model on a politician. We do think that there's unprecedented upside that's not priced into the market, which is if this administration, between 21 and 22, does take a stance around something that changes 280E, where cannabis is no longer part of the 280E side of things, you're talking about the unleashing of a massive amount of free cash flow into these businesses that allows for either reinvestment into the business, distribution via dividends, or capital to use for acquisitions that's not going out to the market and raising expensive equity dollars to do so. And so we recognize that that's something we don't control. We can only optimize our business as best we can. But we do strongly believe that something will happen within the next 24 months that eliminates 280E, which then you really look at the free cash flow models, and it gets very exciting when you start to go through that.
And not everybody can afford to pay these taxes, which in a way is a good thing for you guys, because then you could be purchases at distressed values. But what I would say, this is 280E. What we say here at GreenWave is it's a snake in the grass. I had to use a pun sort of on that, but the IRS, who knows how this is all going to play out with the IRS, and it's just a nightmare. But I do, because I'm kind of stretched for time. But one very important thing I really want to talk about is social justice. And under the new administration, Chuck Schumer's come out. Things are really moving quickly, it seems, and a big component of that is social justice and how that's all going to be reformed and so forth. And with Jay-Z coming on board as your chief visionary officer, and with his insights and influence, and quite frankly, his checkbook, it's a very, it's going to be interesting to see if what comes out of all that is a catalyst and an example that they could look at in Washington and say, hey, let's get this going now. Look what's happening if we, kind of, pull in the reins or lax some of the regulations. So I'm just wondering what your take is on all that. And if there's like anything that we could, that you could reveal that is, that he's moving in what direction with that. Is there any programs that are being established, or how is it's $10 million? Am I correct with that? That he's putting into it?
Yes. So to be clear, just to eliminate confusion, so there is a social equity venture fund that the parent company is founding. So that is part of the use of cash proceeds that you saw there on the transaction slide. This really is to be a cross-section of combining corporate social responsibility with corporate venture capital. This isn't charity. This is investing into entrepreneurs of color who have been disproportionately affected by the war on drugs and unfortunately have the least access to capital given the federal stance. Essentially, you can't go to any form of traditional sources of capital, which means predominantly this industry is being financed by high net worth individuals and family offices. And so when you think about it from that perspective, it really is cutting off a lot of access points, and it's expensive to start a business. And what we're really looking at here is we're looking at this as trying to start a movement. So just as much as we've all been trying to start a movement towards getting cannabis to be legal at a federal level and get it legal in many states as we possibly can, this is about a movement to create more equity and more diversity in the cannabis supply chain. And since we are at the nascency, the very beginning of what legal cannabis looks like, this is the opportunity for us to do that. There is no industry, unfortunately, that is hyper disruptive, hyper fast growth, that's creating generational wealth, that has created a diverse pool. 4% of cannabis businesses are owned and operated by entrepreneurs of color. That's not sustainable. That needs to be 20, 25%. At the end of the day, it is often, those same people who built the cannabis culture are not allowed to actually participate in the upsides of it.
It's crazy.
And for us, we think it is a responsibility for large cannabis companies like ourselves to take a stance, and it creates a flywheel effect. That's the beauty. This is like a Y Combinator type of opportunity that we have. It's to be able to build up entrepreneurs that work together, that learn from it, receive some initial capital, which de-risks their business, which means they can access other capital. Because if they can come and say, I got money from the parent company, that's then going to open up other people. Oh, well, if the parent company believes in them, then I will too, and I'll back up and support them because I know that exists. And it's not just about cash, it's also about infrastructure, right? We can help solve a lot of the problems, legal, compliance-related questions. These are things that you got to go to, an outside attorney is going to charge you $600 an hour, right? That's a big drag on your initial startup capital if you're trying to start a business. And we can help to solve some. We could also plug them into our infrastructure. If they're a cultivator, great. We can handle all the processing, the distribution, the sales for them. If they're a brand, we can help them with the sourcing and procurement and then the distribution. If they're a retailer, we can help to provide them with access to the products and help them through the compliance side of things. Like that's really where we see this as we build these entrepreneurs, and as they become successful, then they will look to help other entrepreneurs. And it really creates that flywheel where we can build an industry that is going to be a multi-$100 billion industry over the next 20 years. And we can have that actually be more representative of a cross-section of what the U.S. population looks like, rather than what we've seen in other areas that I came from, like technology and venture capital. We're talking about sub 1%, right, of entrepreneurs of color. That's really where we feel this obligation and this incredible opportunity to create the most equitable and diverse industry in the world. And it takes us doing it at the grassroots level. You can't do it, once it's fully established and mature. You have to do it now while that generational wealth is being created.
Sure. Well, I could go on forever. I have like so many more questions I wanted to talk to you about and topics, but time really flies. And I do want to take one or two questions from the audience. We have quite a few in the queue here. So if you wouldn't mind, we're going to probably go over maybe 5 minutes, if that's okay. Do you have an extra 5 minutes, Steve?
Absolutely. I'm happy to stay on as long as you'd like. And look, I know we're probably only going to get to a handful of questions. Looks like there's over 30 of them here.
Yeah.
I'm also happy to, if we want to if you want to pull these down, at the end of it, I'm happy to answer all these, and you can send them back out to each of the individuals in writing, so we make sure all of them get addressed.
Yeah, sure. And like I said, a lot of color around the company, and kind of thoughts about the future. I want to put this into a briefing on the parent company, so that should be. I mean, these things take time, but we'll have that. So as I said before to people, if you want to sign up for the GreenWave Buzz, you can hit our website and you'll be on the distribution. So what with the delivery, what do you think the future of delivery services is, and will dispensaries even be needed?
Yeah, I think the reality is, it's something we believed in, when we first started our delivery service in 2017, right? Which is, consumers have shifted, courtesy of this device right here, right? We now have everything at our fingertips, and the reality is we will end up, having the vast majority of transactions occur online. And people want to have access to their consumer products how they want it. And we call it, cannabis on your terms is how we deem it, which is, if you want it delivered to your house, you should get it delivered to your house. If you want to order it for curbside pickup, that we can bring it to you, you should get it that way. If you want to go into the store because you want to touch, feel, smell the product, you should be able to do that. And so we really look at it as an omni-channel approach to meet consumers how they want to be met, which, by the way, is how every other direct-to-consumer, whether retail or delivery business, exists out there. Like, you can do it on Target.com, you do it on Walmart.com, right? All those things you can do, and we're really just bringing that same dignity to the cannabis space and doing that. Obviously, the pandemic was an accelerant to people wanting delivery and people wanting, touchless opportunities, and really wanting to avoid congregation and retail spaces. And look, we had to limit the amount of people we could have in our stores, right? Massively. And look, that our customer safety is paramount to us. Our employee safety is paramount to us. So we moved quickly on that. We were actually the first in the state of California to get approval for curbside. We were the first to actually add in a car hop service where you can order from your car and receive delivery to your car within 10 minutes. Those are key components that we've built out to do it. But the reality is, consumers want to have access online, and they want to be able to have it delivered to the convenience of the home. What we've done is built out all the functionality that they've asked for, right? So we can get you a window of time it's delivered in. We can get it to you express if you need it, but with a limited menu. We really are able to provide those capabilities. The other thing that we see out of it is, I hate to say this, but when you're in a dispensary and you're a consumer, there really isn't a ton of quote unquote browsing opportunity, right? You're in line, there's bud tenders, there's people behind you. Like, you kind of almost feel this pressure to, like, okay, I gotta get get it and get out of the way because the next guy's waiting, right?
Yeah.
And that doesn't exist online. You can spend as long as you want online. And we see that because we see that consumers are spending more time. We see that the units per transaction are higher online. We see the AOV is higher online, the average order value. So clearly consumers are taking that time, and that's allowing them to be able to dive deeper into it. And so that's important to us, and we think that will continue to be the trend. We don't see this going back to it purely in real life. But I don't think in real life goes away. The reality is, for a new consumer, they still want to spend 10, 12, 15 minutes talking to a wellness consultant. For other consumers, they want the opportunity to see what's new, to talk to someone. We do have online chats, and that's great. But at the same time, I prefer to go to my grocery store than to get it delivered to my house, because, again, you get the opportunity to see what's there, to talk to the folks, to build that community. Our job is not to direct people as to, oh, you should only go to in real life, or you should only go online. We just need to provide them the options to do whatever they want, whenever they want. And we've done that. And the reality is when we map our data, we don't have exclusive delivery consumers. We don't have exclusive in real life consumers. They're pinging back and forth based on what's going on at that moment in time. And so that's really what we look at and say that's the power that we need to provide. But I do absolutely believe that online and delivery are going to be the predominant way that cannabis, just like any other consumer product good, is actually acquired by the consumer.
And who knows? It may be in a drone. You might have
right now that's illegal, but yes,
but
at some point, there's no reason why with the combination of facial recognition software, fingerprinting, ID verification, you can do that. And so yes, the technology is there, and if we were allowed to do it, we could have that up and running within 2 months. So as soon as the politicians catch up with us, we're happy to turn that one on.
There you go. I guess one more question, and this is kind of interesting because, since the beginning of the year, we've really had a heightened level of M&A going on here. The question is, how close are you to timing to announcing your first M&A deal? And then as an add-on to that, I had a question sort of related to that. Because you're listed on the NEO, are you able, I guess you could, but is it more challenging to use your stock as currency as you look to make acquisitions? Because the other MSOs are on the Canadian exchange. So is that kind of like a problem, or so kind of, I'm putting my question with somebody else's.
Yeah, so I'll answer your question first, not just because you're the one who asked it, but I think it's just a faster answer, which is, the other U.S. operators, many of them are listed on the CSE, the Canadian Stock Exchange. We're listed on the NEO. The reality is that they are similar, right? You access them through the same brokerage accounts. You can still buy OTC. We're all listed on OTC. So when people ask about the ticker, Gram F is actually the OTC symbol. Gram.U is the NEO symbol. But the reality is, it's as accessible. The places it's not as accessible, it's the same difficulty that every other U.S. cannabis operator listed in Canada has. You can't be on Robinhood. You can't be on some of these other fast-growing brokerage firms because they don't allow OTC. They only allow NASDAQ and NYSE listed. And so we don't have the opportunity because they don't do OTC, they don't do NEO, they don't do CSE. So relative to other U.S. cannabis operators listed in Canada, there is no difference whether you're on the CSE or the NEO. In fact, the NEO is a more senior exchange, which means there's higher reporting requirements. So it's actually a sister exchange to the NASDAQ. So you actually could say that it's a more senior and thus you should feel more confident, but the access is the same. The question that when you think, hey, can you use that as currency? Absolutely, you can use it. It all comes down to volumes, right? So at the end of the day, people should understand that the exchange doesn't determine whether your currency of your paper is liquid. It's your daily volume, and our daily volume has exceeded every other U.S. cannabis operator since we announced this transaction.
Wow.
So our liquidity exceeds anybody else from that perspective. Our net cash, meaning cash minus debt on balance sheet, is highest in the entire U.S. cannabis operators. So net, we actually have two critical advantages when we go to do M&A. We have the most liquid paper currency, and we have the largest cash balance sheet out there. So when you piece that together, that really creates the best opportunity for M&A of any other participant in U.S. cannabis. And so that I just want to kind of lay the framework for kind of the capital structure that we have available to do it. In regards to M&A, unfortunately, the reality of a de-SPACing process is that you're not allowed to really move forward on your M&A prospects during the de-SPACing process. And so that comes from the time where we filed our confidential filing back in October to where we are in the actual, quote unquote, de-SPACing process or qualified transaction that took place on January 15th. It's part of the regulations. Regulations that are protecting investors, so I'm not going to complain about them. Regulations are good when it comes to public markets. The reality is we had to put those on hold. And so now as we go forward to move forward on the M&A side, we had to put some of that backburnered and on hold. So now we're rapidly accelerating through that. A second component is legally we're not allowed to do a transaction for 30 days, which means until February 15th, again, part of that. And overall, the guidance is you can't do anything for the first 90 days. Now, we have to file something called a business acquisition report in Canada. Now, that essentially, I know someone asked a question, when is your Q4 numbers coming out? The Q4 numbers come out in that business acquisition report. So it is a filing. You have to do it within 90 days, which means by April 15th. You can't do any transactions until you filed that report. So we're rushing through to try and get that report filed faster than April 15th. We absolutely believe that we will file in March. And so that will then open the door for us to be able to announce M&A activity and to consummate those transactions. So for the investors out there are wondering, hey, you've got this balance sheet, you've got this strategy for California, you have this incredible M&A team, you have this amazing, robust, vertically integrated infrastructure to plug these things into to get the value out of them. Like, what are you guys waiting for? Well, we're waiting for the regulations, right? And as we get through that regulatory window, you will see in Q2 that's the opportunity for us to be able to. I know Canaccord issued an analyst report yesterday, and they explicitly wrote in there that Q2 is when you should be expecting it, and I think that's a fair assessment as to when we'll be able to come out to the market and let them know about our inorganic activity. Wish it was faster, but again, regulations are there to protect the investors, and so I'm a strong supporter of protecting investors.
Absolutely. Well, awesome. I think the fire's almost extinguished here. So we're going to
light another one. Let's go for another hour.
I wish the thing is, right, like if this was, this would be standing room only, because we have there are a lot of attendees, a lot of people registered. So I wish I could see everybody. You can see me, I can't see you. I miss everybody. Haven't seen anybody in forever. But hopefully, we'll see each other soon at the next gathering. I guess we should conclude now, but I will say we will follow up with all those unanswered questions. And, if you have any questions about anything else, just give me a shout, and I would think Steve's available as well. Absolutely.
But by the way, Matt, if anyone is wondering, just ir@theparent.co. Again, IR like investor relations at now it's theparent.co is the email address. Feel free to send it across. It's monitored every day. We get those questions. We absolutely will respond. We understand that people have a lot of information they're seeking. We want to be able to provide it out there. Again, it's one of those things where we probably need to do a better job on messaging what we're doing and how we're doing it. But the best way that we can find out what people are curious about is by outreach. And so whether you reach out to Matt, and I think folks are asking again for your email address, Matt, to be able to send it to.
Oh yeah.
Or to send it to ir@theparentcompany.co. Either way, we'll get an answer.
Absolutely. All right, great. Well, Steve, thank you so very much for your time today. Really appreciate it. I wish you all the best and your team. I know you're going to continue to do well. And I look forward to the next Fireside.
No, thank you, Matt. This has been great. Appreciate it. Appreciate all the attendees coming through. Great questions, and wish we just had 4 hours to go through this.
I know, but, believe me.
As soon as we can get on again here and it works for you, happy to follow up. So just let us know.
Awesome. All right. Take care. So long, everyone.
Thank you. Take care.
Bye-bye. Bye-bye.
Bye-bye.